Welcome to the Cardinal Commentary for the foreign equity portfolios. There's been a lot of talk throughout 2022 about bear markets, rising inflation, and rising interest rates. Maybe too much talk. If you didn't know any better, you might think the end of the world was around the corner. Well, the good news is we've been here before and the world is not about to end. There might even be a ray of light on the horizon. Using the S&P 500 as our guide, there have been 11 bear markets, that's a drop of at least 20%, over the last 75 years. And on average, they've lasted 12 months with a market decline of 34%. The current bear market is nearly 11 months old. While that doesn't mean it's about to end, it's worth noting what happens once the bear market is over. Over those same 75 years, the ensuing bull markets have lasted an average of 4.5 years with a market gain of 160%. In the long run, it's far riskier to miss out on those bull runs than to get caught in the bear markets. But even when the markets are down, there are good companies and, more importantly, good investments to be found. Here's portfolio manager Sheila Wilson-Cole on Honeywell.
Honeywell is one example. It's a company that's been around for decades. It's very well managed. It's a diversified industrial company, pays a good dividend, and it's in terms of its earnings, it's often one that doesn't surprise. It's consistent, grows earnings, grows revenues, and delivers dividend increases each year.
Honeywell is one of those companies that doesn't let a good crisis go to waste. Nearly 3 years after the COVID-19 pandemic started, it announced a 5.1% dividend increase, the 12th consecutive year it has done so. And over those dozen years, its dividend has tripled. Honeywell's dividend yield is now 2.3%. Honeywell recently announced that it grew its net sales, profits, and earnings per share in its just completed third quarter. Honeywell isn't the kind of stock that's going to shoot to the moon, but that's exactly why we like it. The company has been a steady performer, not just for years, but for decades. It doesn't garner a lot of headlines, but portfolio manager Terry Wong is just fine with that.
Yeah, some people like to think that boring is better, and obviously we do. You know, when you find these good quality companies, these stable companies, very conservative, they're not flashy, they're just very good operators, and they operate at a pace that we really like to own in a portfolio because they know how to make money and they know how to pay us.
We slightly underperformed the benchmark in the third quarter as a few of our companies saw their share prices fall amid recessionary fears, but we've never focused on short-term returns. Over the last 20 years, our foreign equity portfolios have posted an 8.74% return, outpacing the benchmark of 8.07%. Or, put another way, if you had invested $100,000 in this portfolio in 2002, it would be worth nearly $450,000 today. And why do we do all this? Because it works. And that's the Cardinal Commentary for our foreign equity portfolios. Thanks for joining us.